If you are a real estate investor, have interest in investment real estate, and you're curious as to how do you form a syndication, or on the investment side, how do you choose one syndication from another to invest your money, then lock in. Today's the show for you. Hi, I'm Kris German. Welcome back to the Apartment Dealer Show. With me today, we have Mr. Steven Spierer. Steve has been a practicing real estate attorney for the past 47 years, running Spierer, Woodward, Corbliss, Goldberg here in Redondo Beach, California. He's a prolific real estate attorney, but we're not going to talk real estate law today. Today, we're going to talk real estate syndication. In the same amount of time that Steve's been a real estate lawyer, he's actually ran a real estate syndication, a very successful real estate syndication, which now today owns over 10,000 multifamily units, owns retail space, warehouse, industrial, every facet of commercial real estate. And Steve and I are going to discuss the do's and don'ts of running a syndication or investing in a syndication, and cover many of the basics and advanced theories to syndication investment that you need to know before forming a syndication or investing in a syndication. So with that, let's welcome Steven to the show. So Steve, welcome back to the show.
Thank you very much, Kris. Great to be here with you.
And of course, you and I have hours that we've recorded that live here on my YouTube channel with respect to real estate law, which is how you and I got to first know each other. But today I thought we'd take a different angle here. Of course, aside of the successful law practice that you run, you are a very successful real estate investor in your own accord. I know that we talk about some of the numbers here, over 10,000 units that you own, manage, and operate. You've been running the syndication for some time, and so I thought, you know what? Let's discuss that. Right now we sense that there's a buying opportunity in the market. I think that will only increase. And a lot of folks saying, okay, well, I want to partner together. I know a few folks that have money. They know individuals of high net worth. Maybe they're the brains. They understand real estate. But their friends and family or business associates don't necessarily know real estate, but they have money, so they see an opportunity to bring folks together to help with their real estate ventures. And so we want to dive into syndication, start from the basics. Can you break down what a real estate syndication is and how it differs from, say, a REIT or some other venture?
Sure. So let's start with what a REIT is. REIT, Real Estate Investment Trust, and these are listed on stock exchanges. So you can buy shares of a corporation, and that corporation, that real estate investment trust, owns real estate. And there are some that emphasize apartments, some emphasize big box, others retail, others commercial, and others office. And you can buy shares, and it's just like anything else, any other stock. You buy shares, you can sell the shares, you can get your cash in 24, 48 hours, high liquidity. And depending on the portfolio and the skill of the management, they can be good investments. They can be relatively good investments. And they're publicly traded so that they're subject to audit, public audit and standards, and the Securities and Exchange rules. So there are lots of protections against people buying big hunks of blue sky. So that's what a REIT is. A syndication is not really an official legal term, but what it is a description that could be called a private placement. And this is where a group of people are brought together by a promoter, a syndicator, who says, look, I'm going to find this property and I'm going to find the money, and we're going to put those two together. We're going to own this together. And what we do, when I say we, I mean John Woodward and I in Wood Spierer Properties, What we do is we take investments from friends and family and clients and ourselves. John and I are always either the largest or one of the largest cash investors in any of these investments, and we buy a specific property. So we form a limited liability company, an LLC, to own the property, and then it's owned by its members, and its members are the people who invest. So that's John and me, and all of the other members who put their money in. We buy the property, that particular property, and we own it together until we don't. And every one of them is freestanding. So that's the overall structure, but it's private. It's not publicly traded. It's not liquid. You can't really sell it on the street. There are methods to be bought out, but you're bought out at a discount. So it's illiquid. And you don't have control. The control is in our hands. We're the ones who make all the management and executive decisions, all of the decisions. And so the deal for an investor is you write a check and you get checks. That's the deal. You don't have any management responsibilities, but you don't have any management rights.
Now, why an LLC, not a limited partnership, a tenancy in common? Why an LLC?
An LLC is a very convenient way to arrange things because it's a separate legal entity. All of the tax benefits flow through to the investors. And what we do is we have 99% of the tax benefit go to the members. 1% goes to John and me because it has to under the rules. And then John and I also get our pro rata portion for the cash we put in, but we stand on equal footing with everyone else. So all of the tax benefits, the depreciation and any investment tax credits, if there are any, depending on what Congress does that particular year or set of years, that all flows through. So that's one reason. So the first reason is the convenience of a single entity. The second reason are tax benefits, where the tax benefits flow through to individuals. The third one is that when you have a loan, a lender likes a single purpose entity because they don't want complications. They want a single asset entity. And so that would be a reason. The reason we don't do a limited partnership is because then there has to be a general partner, and then the general partner has liability. And so what has to happen is the general partner forms a corporation. Now you got another entity to protect themselves. It's just more cumbersome. And tenants in common would be not as desirable because you have too many people. We'll sometimes have 30 people, 35 people in investing in a single property because they're fairly large. And to have that many people where you have to get signatures all the time to do things, it can be done, but it's more cumbersome. It's just easier to have control in John's hands and my hands, and no one else needs to sign anything. Now, the biggest thing you have to do if you're ever going to invest with someone like that is they have to pass through two filters, the sincerity filter and the competence filter. The sincerity filter is if you invest with someone where you don't have control and they're making the decisions, you have to trust their integrity, that they're not going to self-deal. They're not going to run their cell phones through the company or lease their cars through the company or fly on private jets through the company. You have to know that they're going to be trustworthy to make all of the decisions that have to be made in favor of the investors. So the first filter is the sincerity filter. The second filter is the competence filter, that someone might not know how to acquire a property, might not know how to pick a property. More importantly, might not know which property not to pick, and that they may not know how to manage it or when to sell it or when to refinance it or when to raise the rent or how to deal with a dissatisfied tenant and on and on. You're trusting this person to run it for you. On the other hand, you don't have to run it and you don't need to know how to run it. And so investors in this should be people who have neither the time nor the inclination to do it themselves. Many people are very successful on their own in doing it, but only if they're paying attention. It's the sort of thing you can't, anyone who thinks it's simple is going to get in trouble. It's complicated, but if you pay attention to it, a lot of people can do it. It's not beyond the ken of most people.
And under the umbrella of sincerity and competency, of course, you mentioned that you and your partner, who are managing the syndication also are invested in it. But what about where the manager has no skin in the game? So they're just managing it, and because oftentimes they'll have no skin in the game, but they'll take 10% off the top, right? So the ownership of the property is being made up of the cash that's being brought to the table by the actual investors, but the manager is still taking, say, a percentage of ownership. What's your take on that?
John and I opened our law practice on January 10th, 1978. We were very fortunate to have as one of our very early clients a syndicator who did then what we do now. And we saw him doing it correctly. Then as lawyers, as real estate lawyers, we saw a number of syndicators who did it incorrectly. Then as real estate lawyers, we saw a number of people who had given their money to other syndicators and needed to sue them because they had lost their money for them. And there's an old saying that the only thing people hate more than losing money is the people who lost it for them. Mm-hmm. And so these are very, very angry lawsuits that are brought, and we represented some of those investors against some of those syndicators. We represented some syndicators who did it really correctly, others that didn't, so we had to help them do it correctly or help them adjust and pay and be responsible when they didn't do it correctly. And so John and I had a chance to see how other people were doing it. My dad always said that any idiot can learn from his own mistakes, but it takes a wise person to learn from the mistakes of others. And so we learned from the mistakes of others. And here's what we figured out. A syndicator who comes to you and says, I'm really smart, I have this great opportunity, I figured it out, and I'm broke, so I need your money to be able to have us go make money together, but I'll put in sweat equity. And you just put in the money, you don't have to do any work, I'll do that. And the reason I'm not putting any money in is because I don't have any money. Well, why don't they have any money if they're that smart and if they know that much about real estate or that much about whatever the business is that they're generating? I'm going to want to see a track record. And then I'm going to want to hear that a syndicator has enough confidence in the investment that that's where they're putting their money. Mm-hmm. It's like you're a chef in a restaurant, but you won't eat your own cooking. We eat our own cooking. And that's what you should look for in any syndicator, is someone who says, look, this is where I want to park my money. I can tell you that John and I know that if we had enough money to buy these large projects ourselves, we wouldn't have any investors. We just buy them because we like them. And so the overwhelming portion of our net worth is in these properties with our partners. This is where we put our money. And if we could find more properties that are suitable, more properties that we found acceptable, we wouldn't have any money anywhere else. We'd put it all in there because we believe in it. And that's what difference it makes when a syndicator puts money in on their own. You show me a syndicator who says, I'm not putting any money in, or I'm putting in a teeny tiny bit of money, and I'm going to show you someone who I'm going to say isn't ready to syndicate. They need to go do these things on their own first, because they'll make plenty of mistakes. Make the mistakes on their own before you take other people's money. It's a tremendous responsibility to take the money of others. And if you want to stay awake at night, take other people's money and take it seriously.
You know, there's a old acronym, OPM, other people's money, right? So people see the opportunity to make a return on other people's investments. But obviously there's a risk in that. And so aside of the risk that even against the best intentions, real estate goes in ebbs and flows. Maybe you catch the market at the wrong time, or even amidst your best investigations, a particular location just didn't work out. So, obviously those are common mistakes. But, beyond that, I've been asked by many clients, hey, Kris, they'll see some of our, say, videos on YouTube where we've done renovations of properties and what have you. And they'll approach me and say, Kris, we'd like to invest alongside of you. And not once have we done this as of yet. We are at this point, we only buy our own properties. Maybe my teammates and I might have partnered together, but never have we taken clients' money. And probably with the push of a button, we could raise several $1 million fairly quickly. But I just see that the risk versus the reward, I haven't crossed that bridge. So aside of just picking the wrong property, what other risks are involved with the individual saying that they're going to step up and manage this thing?
Picking the wrong property, mismanaging the property, not financing the property correctly, not having proper leverage and not over leverage on a property, making personnel decisions, hiring and firing staff, delegation and follow-up decisions, capital expense decisions. How much money do you invest in a property to do something with it, to change it? Do you build that children's play area or do you not? And if you're going to build it, what quality do you put in? Where do you cut corners? Where do you not cut corners? When you are remodeling or updating an apartment, are you putting in new cabinets or are you just doing carpet drapes and paint? And there's a balance, and it's a question of return on investment.
Mm-hmm.
So if I can spend $12,000 improving an apartment unit, that's a lot of money. But if I can get another $100 a month in rent, that's a 10% return, $1,200 a year on a $12,000 investment. That's a 10% return on the money. I might not do it for that. But if I can get $200 more rent by putting in $12,000, I get a 20% return. I'll do that all day long. But then another mistake can be misassessing the market for what it'll be when you finish it. So you've got to be able to figure out what the rent's going to be. You need to have full knowledge of the rent stabilization ordinances, rent control, if there are in your area. You have to have full knowledge of all of the anti-steering regulations for renting apartments, all of the rules for communicating with tenants, all of the rules for responding to tenant complaints. What do you do if there's a complaint of mold or mildew? What do you do if a tenant doesn't pay rent? What do you do if a tenant brings in a dog that wasn't supposed to be there, or more people that weren't supposed to be there? There are thousands of decisions that are made every year, and they all must be made correctly. And any one of those decisions that's made incorrectly can result in losses, lost opportunities, or even lawsuits.
From the investors involved, aside of the individual who's managing the syndication, doing something nefarious, they use the funds for their own purchases, like you said, they're leasing the car through the LLC, they've got the price, obviously these are very obvious things that they could be sued for. But if the manager, to the best of their ability, has managed the property well, and they got a few bad apples in the property, tenants who knew the game, and so that took a hit to cash flow because these folks didn't pay rent for months on end, and they bumped into a contractor who took advantage of them on pricing. So again, nothing that the manager themselves did, circumstances. What can, I imagine they can be sued for anything, but what do you see would be a good lawsuit on behalf of the investors where they would have grounds to go after the manager in the event their money is lost, it's a bad investment?
So the very first thing is co-mingling, where someone goes and takes money from, we've seen syndicators do this. They have multiple properties. This property is doing really well and has a bunch of extra money. This property is in trouble. So they have this property A lend money to property B. This is co-mingling. This is improper. Unless that's the arrangement, unless there is one investment that has multiple properties, that's fine. That's fully disclosed. That's handled. But if that's not what it is, if they're supposed to be separate and they co-mingling. Another form of co-mingling, which I'll call embezzlement, is where a syndicator takes money and pays personal expenses. They're stealing money. They're using it not for the proper purpose, not for the purpose that they have a duty to use it for, but instead for their own purposes. Or they just borrow a little money because they need, but they're going to pay it back and then they can't. And again, co-mingling and forms of embezzlement. That's probably the most egregious and frankly the most frequent one we see, because people sometimes who do this don't have any idea that they were not supposed to do it, because they didn't have the moral compass, they don't have the legal understanding, they don't have the accounting understanding. They shouldn't be doing it to begin with, but they did it. They just thought, wow, this is great. We can get together and make a bunch of money and I can get fees for it. So that's the first thing. I think probably the others are all far more routine. They are someone who over leveraged the property, borrowed too much money and then hit hard times and couldn't sustain the property, so it's lost in foreclosure. Or there are high interest rates because they had to refinance unfavorably, or some other problem, and the money is lost as a result. And the defense, the syndicator, will say, look, that's the market. That's one of the risks you took. But you should be able to anticipate those things. If you're doing it right, you should be able to anticipate them. But that requires that the syndicators avoid the two pitfalls of investment. And these are the pitfalls for everybody, for every investment: greed and fear. So greed would lead someone to buy more, to bite off more than they could chew, to over leverage, to buy a property that's too big, that they don't know how to manage, to act too quickly, to grow, or to buy too many properties that they can't handle and can't coordinate. Those are things that then the criticism would be, well, you wouldn't have lost it in foreclosure if you'd done it right. And then from there, it goes down, because you'll have some people are guilty of some form of improper behavior with employees, or improper behavior with tenants. And improper behavior could be all kinds of things.
Mm-hmm. Sure.
And the list goes on. But the biggest one is this co-mingling or embezzlement or misappropriation of funds. And it happens, of course, I see it because I'm a lawyer who gets hired to sue those syndicators. So I see it more often than most. But that's the one that's the most awful.
And can you explain the difference for us when, the different types of folks one would reach out to raise the capital between a 506B and a 506C syndication?
I don't know what that is.
Oh, so that's the difference. Well, my understanding is a 506B is family and friends. You can approach family and friends, but you can't openly market to raise the funds. And a 506C would be you openly market to just about anyone.
It's so funny because we've been doing this for 47 years. We opened our law office 47 years ago, did our first syndication 46 years ago. And I have long since forgotten the code sections, but here's where we are. We're in the family and friends, a pre-existing relationship, something where we know the people. We don't want to market to the public because we're not a public company, or we don't want to do that even in a private company with others. And the reason is because, and this isn't intuitive, the first thing that is intuitive is that anyone who hands money to a syndicator, you need to trust the syndicator. That's mostly what I've been talking about with you today. But the syndicator needs to trust the investor, and we need to vet the investor. We need to know the investor, because, as I said earlier, the proper investor for an investment system like the one we structure are people who have neither the time nor the inclination to run it or do it themselves. And so we have to make sure that's not someone who thinks, yeah, I have a lot of opinions and I really want to be involved. We don't want anybody involved. We have made all the mistakes over 47 years. We've made all the mistakes we need to make. We want to make new mistakes. We don't want to have to argue with someone about it. So we don't want that person. One. Two, this is a highly illiquid investment. So we have to make sure that truly the person who's investing understands that the plan is to buy this property and not sell it. We sell properties on occasions, but it's only when there's a reason. The area has changed, or the property hasn't turned out to perform, but it's very rare. We have properties we've owned for decades, and anything we buy, with one exception, a special project we did back in the late 80s, with that one exception, we've never bought a project that we didn't intend at the beginning to keep forever. So we have to make sure that an investor understands this is an entrance with no exit. What's your exit plan? We don't have an exit plan. Our exit plan is I'm going to die owning it. And maybe my children will die many decades later owning it. And maybe all the grandchildren of all our investors, they'll own it. So we've got to make sure of that. The next thing we have to make sure is that the expectations are right, because these are long-term investments. You might invest and get an immediate tax-sheltered cash flow of, say, 5% or 6% or 4%, and it's going to go up, but it's going to go up over years. So the expectation has to be of the investor that it's going to grow, but it's going to grow very slowly. You don't double your money next week. You don't double your money next year. And as a consequence, it is not it's not something that is for everyone. This is something that is for, so we are exclusively that, what you called friends and family operation, because we don't want strangers. We don't want them. So I'd forgotten the code section numbers, and that's a decision we made almost a half century ago.
Sure. Now, what about oversight and the SEC? What are the regulations surrounding these syndications, and what are the consequences not to comply?
So we fall in the category of what's called a private placement. So we are not registered with the Securities and Exchange Commission. And so the requirements for that, there are many requirements for that, and we comply with that. We have 35 or fewer investors is one thing. We're not open. We don't have thousands or hundreds of it. We have 35 or fewer investors. And these are not blind pools. We don't say, give us the money to put in our pocket and we'll go out and find you a property. It's, we have a property. Would you like to invest in this property? So it's not a blind pool. It's a specific project, and on, lots of regulations that we follow, but we're not registered as a security. None of our transactions are registered as a security. And so as a consequence, we don't have all those regulations, like audited financial statements and all sorts of rules and regulations that we have to follow.
And as a syndicator is structuring their deal, what would you say are, especially as new syndicators, are the top mistakes that you see, and how can they be avoided?
So I would say it's some of the stuff we've talked about in terms of, you got to figure out who your investors should be. Who do you let in? And we've had a lot of people who said, yes, I'm very interested in being in this. Would you put me on your list, please? And we don't. They're not. It wouldn't be good for them, and therefore it wouldn't be good for us. A second thing is, be careful what you buy. You never get hurt by not buying a property. Another thing I'd suggest for a syndicator, and this is really important, is John and I have always been lawyers, and we make our living as lawyers, and we provided for our families as lawyers, and then made money so we could also invest. And now the investment company has far eclipsed the law office in terms of providing for us, but we never had to make a deal. We did something else for a living. And the best syndicators, in my experience, the ones I've met, are the ones who are doing something else where they don't need to make a deal. So we have missed out on many, many deals where we probably would have made money, but they weren't clean enough, or they weren't clear enough, or it wasn't profitable enough, or it didn't look like it would cash flow soon enough, or it looked like there could be management challenges that would be hard to meet, or there were all sorts of reasons why it looked like probably it'd be pretty good, and we'd make the fees for setting it up, but we were never motivated to do that because we didn't need to. So what we did is we've only picked the best of the best. And even at that, sometimes we'll get one that will underperform. So if I'm looking as a syndicator to try to do this, you're going to be very careful. We, over the years, have only bought an average of like 1.2 properties a year. But sometimes there have been years we bought 3. There have been 3 or 4 years when we bought none. And so we're very discriminating about it. That's probably a lot of other people make a lot more money for themselves and for their partners than we do for ourselves or our partners. But they also take much more risk. And I am a believer in the notion that every investment in life, in fact, most decisions in life, should be a balance, always looking at the downside risk. When someone comes to me and says, I've got a deal where you can make a lot of money, my question is, all my questions are, okay, what could go wrong? And what else could go wrong? And what else might go wrong? Because I want to know about downside risk. If you tell me you doubled your money in something over a period of time, I want to know what risks did you take to do that? So it's a matter of an attitude as much as anything else of looking at what can go wrong. So the result is you don't get rich quick. You have to be very patient if you're going to be a successful and effective investor to begin with, and certainly a syndicator. But you have to look at this and say, this is going to take a long time for me to develop this and make it work. John and I, poured money in for a good 15 years and made nothing from this for the first 20, 22 years. Now it's going very well. But for the first couple of decades, we took out zero money, but we put in money after money after money. And if someone says, I'm going to be a syndicator, I'm going to make money right away, that's not someone I'd invest with.
I just
I don't mean in a now I'll tell you, we'll buy a property, it'll produce cash flow right away. I'm not talking about, I'm saying someone who's beginning in syndication who says, I'm going to start being a syndicator, that's how I'm going to make my living, and I've never done it before, that's who I'm not investing with.
So I was going to say, I just represented a client, sold an apartment building for her in the Valley. The buyer was a syndication, not represented by us, but represented by another agent. He wrote into the contract a fee for him of $250,000, which they stacked on top of the price. Essentially they stacked it on top of the price. So right at the close of escrow, this guy who's running the syndication makes $250,000. And we're not talking about a $10 million deal. We're talking about a $4 million deal. So you think about percentages here. So let's talk about the syndicator and profits for them. And I'm not asking you to disclose how you run your syndication, but in general, the individuals that are running the syndication, obviously they are taking the time to vet the properties, the oversight of the management. Typically, aside of the money that they have invested into the property along with the other investors, how are they also benefiting financially from running the syndication?
So first of all, we're capitalists. And second of all, this is a project that is designed to make money for the investors and for us.
Sure.
And so that's the starting place. This is not a nonprofit organization. This is something that is being done for profit. And so you start with that proposition. So we're going to get paid fees, and we're going to get paid fees for organizing it. We're going to get paid fees for managing it. And then we're going to own a piece of the profits on the back end after the investors have gotten all their money back. Then we're going to share it in different percentages, and it's different from one deal to the next. And so there are going to be fees. Those are all concrete, and they are all described in the private placement memorandum, which is a book about this thick that discloses all of the risks, discloses all the fees, and talks about all of that. And there's a range of these fees, and I've seen every combination you can imagine. So when I hear that someone took a $250,000 fee upfront on a $4 million purchase on a purchase that's a total of $4 million, my immediate reaction is, well, okay, if that's justified, if it makes sense, that's fine. And it's not a question for me of how much work does the syndicator do. I don't care. It's not a question for me of what do others charge. I also don't care. It's a question for me, how do the investors turn out? So if you could show me that in a way that is provable and demonstrable and reliable and sensible, that this purchase of this $4 million property is being made right here, and today that property is worth $8 million because of something, or if you can show me you're buying it for $4 million, you're going to put in $1 million and it'll be worth $12 million, okay, fine. If it's a $250,000 fee, the investors are going to turn out well. And that's a special opportunity. And it's fine with me if the syndicator makes a great deal of profit doing it. But the question is, what's the risk and how do the investors turn out? So I won't per se say that's the wrong fee. I'll say, I have a lot of questions. I want to know a lot of things. I want to know the thinking. I want to know the theory of the deal, which is another thing. It isn't just let's find a property that we can buy. It isn't just let's find a property we can afford to buy, meaning I can pull together the down payment, I can qualify for the loan, I can afford to hold it, negative cash flow, or it's a neutral cash flow. We think that's not what's the theory of the deal? Why are we buying this property? Do we think we're going to create value? That we're going to invest something, change the property, and make a great deal more money than it's worth, than it was worth when you bought it? Do we think that we're buying it under market? If so, let's be very careful. Are we really buying it under market? Is it actually worth more? Another one would be if we can buy a property that for all the combination of variables can immediately generate a cash flow to the investors after all fees and costs, okay, that's a theory of a deal. But to just say, I'm just buying a property because I would need to buy a property because I want to get started buying property.
Because I raised money. Yeah.
Yeah, because I raised money. Right. That's not there's no, you mentioned OPM, other people's money, the concept of that. I've heard so many people cynically talk about this, that, oh yeah, no, I don't lose money, my investors lose money, or I don't put in my own, I use other people's money. OPM, that's cynical and it's wrong. To me, if you're going to take other people's money, that's a sacred duty. That's something that has to be managed with integrity and with competence, both. So did I answer the question?
You did very well. And as we get ready to close things out, I have one final question. So the individual watching this, they're contemplating creating a syndication. They're going to manage it. As they self-reflect, what skills do you think separate successful, one syndicator from another, personal qualities, character, so that someone can really look themselves in the mirror and say, yeah, maybe that's not me, or you know what, that's me plus some. What do you think that person is asking themselves?
Great question. So first of all, anybody who's eaten in a nice restaurant has looked at it and thought, I can cook. I cook at home. I make a great steak on the barbecue. Maybe I should open a steakhouse. Well, probably not, because there are 1,000 factors that go into it. And many a person who thought they could cook has lost a fortune in the restaurant business. And I say this because we've represented a lot of restaurants, gladly many very successful, but others not, from people who thought that. The same thing I would say is, someone who says, well, yeah, I bought a house. I bought 2 houses, and so I think I can syndicate. No. The ideal structure is that you're a CPA, or you're a real estate broker, or you're a real estate lawyer, because we've seen syndicators who are personal injury lawyers who they don't know real estate, so they have a problem. So it's a matter of being a syndicator in a business where you've got some leg up. Then it's a question of finding the right people to fortify you for what you don't have. So, for example, I'm not a CPA, so we have to find excellent CPAs. And I'm not a real estate broker, so we find excellent real estate brokers. We are real estate lawyers, so we have that piece. So that's one thing. The second thing would be an absolutely squeaky clean integrity that says, I owe a duty to these people to safeguard their money and follow the first rule of all investment. The first rule of all investment is not make a bunch of money. The first rule of every investment is don't lose the money.
There you go.
If you don't lose the money, you probably turn out okay.
Mm-hmm.
But if you lose the money, it didn't do anything. And if you lose the money, somehow you probably took too much risk or misjudged something. So that would be a second thing. A third thing would be that to back up that integrity, that good intent, to be honest, you have to be in a financial position yourself where you're not dependent on the syndication, so that you aren't even tempted. You don't even have to look at it and say at some point, might be better for the partners if I kept this property, but I think I'm going to sell it. Or might be better if I sold it, but I'm going to keep it because it's not good.
That need will cloud your judgment really fast.
Yes, and it's easy for people to become confused, and you can't walk the line. You have to stay a mile away from that line. It has to be where you can truly sit back. I can't tell you over 47 years, how many thousands of times John and I have looked at each other and have said, okay, well, let's identify two things. One, if we owned this property, just the two of us, what would we do? And for the sake of the partners, if we were just an investor, what would be best for us over there? And when those two are aligned, then we know what to do because it's the same. And so many has been the occasion where we've said, yeah, this is a hard conversation to have with our investors because we're going to tell them we need them to either put up more money or lend money or do something. But if John and I owned the property, we would absolutely borrow this money to make this improvement. I'll give you an example. A property where and this is one that we bought just going on 3 years ago, where we had tremendous opportunities to improve the property. And so we funded it to make improvements. We were buying a property for $47 million that once we finished the improvement, we anticipated would be worth about $63 million. And we were only going to have to spend $5 million to do it, $4 million to do it. When we got in, what we found is that we had planned on funding all of those improvements with those funds and funds from operations, and still give a cash flow every month to every investor, okay, starting out at 4%. So the idea would be we'd spend this $4 million, we would add funds from operations, we would continue to improve it. Over a period of several years, the property would be improved, and then the cash flow would go up significantly. What we discovered was that we were able to generate even more revenue from rental than we thought, because what we were doing was that popular with the tenant population, and the market in that economy allowed us to raise the rents that much that we thought, wow, to do it the way we were going to do it is going to take several more years. If we had more cash, we could do it much faster and realize those benefits for our investors and ourselves much faster. So we need more money. So we went to the investors and we said, John and I think we should do this. We think we should do it now. We're perfectly willing to lend all the money necessary ourselves, but we'll charge interest for that. So if you would like to lend the money, all the investors in the project, if you would like to lend the money and you get that interest, and we were paying 7% interest, you can lend the money, and John and I will personally guarantee your loans. They're guaranteed by the partnership and by the LLC and by John and me personally. And no pressure, lend it, don't lend it. To the extent you don't lend it, John and I'll lend it. And the way we came to this decision is John and I said, if we owned this property alone, what would we do? We'd go find that money. We'd go borrow the money. We'd do whatever we needed to do to get that money, to put it in and accelerate this, because that's going to make a lot more money, a much faster, safer result for the ownership than if we wait. And then what's good for the investors? That's very good for the investors, because they'll get higher cash flow sooner at a property that's worth a great deal more sooner and more safely than over time, where we have the vicissitudes of the economy that we don't know what's going on. We don't know what the future holds. So we should get it done. So when we aligned, where we saw that this is what John and I would do if it was ours, and this is what would be good for the partners, then we said, that's what we're going to do. And we went and did it. And everyone understood and everyone's happy. And in fact, we just increased at the beginning of this year, 2025, we increased the distributions to our partners, to our investors, and ourselves, to the extent we own it, by 33.33%.
Wow.
Overnight after 2 years.
Sure.
Overnight, January 1st, we started increased distributions, and they'll go up from there. So it's a question, when you're thinking, to get rid of the conflict of interest by identifying what your interest is, comparing it with the interest of the investors, and if it doesn't match, you don't do it.
Well, Steve, you've been more than gracious with your time. I know the viewers will find this very insightful, a good starting point to put them on their path. Obviously, there's a lot more work for them to do if this is something that they're contemplating on and venturing into. What's the best way? Obviously, again, we start out by saying you and I came to know each other because you're one of the best, if not the best, real estate attorney that I know. So if someone's looking for further advice with respect to syndication or just real estate law in general, what's the best way to contact your offices?
2 ways. One would be call 310-540-3199. And I know Kris has a way to generate that, so I'm sure it'll show up at the bottom.
It'll be here.
Or email steve@practicallawyer.com, steve@practicallawyer.com. We would be happy to have our calendar manager contact you, coordinate a consultation date with the right attorney. We have, I think, 16 attorneys here in our Denver office, Denver, Colorado. And we'd be happy to help people who are considering making investments with a syndicator. We'd be happy to help syndicators who are trying to figure out how to syndicate and what the legal challenges are of that. And if you take a look at our website, practicallawyer.com, you'll see everything that we do that has everything to do with real estate, business, and estate planning. And we're happy to help.
Steve, thank you, sir. And we will see you at our next educational luncheon.
I'm excited to be there. They're so great. The panel that you assembled, Kris, is terrific because there's actually information that is offered and presented to your excellent audiences, and it's actually useful. I'm fairly particular about where I'll do those things, and it's always a privilege because the people you bring together are there to help, and that's the name of the game.
Well, thank you, sir. And the events wouldn't be the same without you, so we'll see you here soon.
I'm looking forward to it. Thanks very much, Kris.
Thank you. My hope is that Steve's insight helps you here today. If you're looking to form a syndication, you're looking to invest in a syndication, all can be well, but Steve shared with us the trips and traps and so forth that one needs to be cognizant of. I hope you found the information helpful to you. If you found the video informative, please give the video a like. Subscribe to our channel if you haven't done so already. Not only do we have hundreds of hours of content on our channel that you should peruse if you're just with us here for the first time, covering all facets of investment real estate, but in the weeks and months ahead, we'll be covering all those topics that impact investing in multifamily properties, specifically here in Southern California, that will help you in the building of your financial legacy. I am Kris German from The Apartment Dealer, and until next time, I wish you positive cash flow, tenants who behave, and protection from Uncle Sam. Till next time.